Hey everybody, Michael Andersen here, and the last couple of days has been an incredibly wild ride, to say the least, with the stock market. Now, as investors in the Evo program, there are a lot of questions coming my way about Evo and what's going on right now. So we reached out to our strategic partners who run the Evo algorithm, Potomac Advisors, and have the following frequently asked questions and answers for you. So one of the most common questions I'm being asked right now is, why is Evo in the market right now? Well, we've been in the market since January 24th due to several consecutive buy signals. Number one, until last Wednesday, Evo was on a buy due to a signal from one of our new trading system combinations added in Q3 and Q4 of last year. This combo has a 73% win rate in over 30 years of backtests with a compounded annualized growth rate of 164% when invested. Number two, last Monday, a seasonality plus long-term system combo kicked in, which has been successfully used by Evo for years. Historically, the win rate is 79%, with over a 130% CAGR when invested in over 45 years of backtests and real-time data. Number three, on Thursday and Friday, several existing short-term systems that work with other long-term bullish trading systems generated a buy as a result of continued declines. These buy signals generated the most trades in Evo last year. And number four, today, our number one performing combination in terms of rate of return when invested went on a buy. It is very short term and also has its own S&P 500 2% stop. The next question, is Evo going to go to cash anytime soon? Well, it depends. If the market continues to degrade, our 7.5% stop loss on the S&P 500 index from our January 24th entry could be triggered. The stop loss is measured based on the S&P 500 index and not the RIDEX Nova fund. That level is not far away, and if we break it today, it could be triggered. The question is, will the market bounce back before the close today, as it often does, if this turns out to be what's called a classic selling climax? Should we meet our stop loss threshold, it would only be the second time that Evo has been stopped out in real time. The stop loss was introduced in 2015, but backtested over 30 years. In 30 years of backtests, there was only one other stop loss occurrence, in addition to the one real-time stop loss in January 2016. Otherwise, the previously mentioned buy signals would keep us in the market should we not hit our stop loss. The next question. Evo has had several hair triggers last year. Why is it not responding similarly now? Well, in Q3 and Q4 of last year, we discovered several new systems, which we added to the Evo composite. These additions helped us to gain 6.78 in Q4 and 5.73% this past January. Now that's gross of fees. With the addition of the new systems, Evo projects longer trade durations overall, less one-day trade, and fewer hair trigger sell signals. The new additions also improved Evo's overall performance across all time periods, which is a requirement for inclusion in the algorithm. While it may not feel like it now, this new system combination has actually helped us mitigate our losses during this trade. When the seasonality combination, referenced above, generated a buy signal last week, we were up on the former trade. If this new system combination did not exist, we would have entered the market on the 29th and incurred a larger loss. Also, some of the same systems that gave us our hair trigger sells last year are now giving us our buys over the past few days. These systems work great when they buy on a market dip and sell on a rally. Last year, the only downside to these systems resulted in getting out too soon. But the risk here is that the rally that follows the rare waterfall decline may be too late to recover what is lost in the interim. The next question, do you expect to go short anytime soon? In order for a short to be triggered by Evo, all of its systems would have to go to a sell. That is very unlikely at this time. Nor do we consider this technical impulse reaction, possibly due to more and more algorithmic traders in a very overbought market, to be of substance. We elaborate on this belief with the next few questions. So, can you recover? While past performance never predicts future returns, this feels a lot like January 2016. During our first trade of that year, we experienced a drawdown of 15% when the market was responding to the first of a much anticipated Fed funds rate increase. We ended the year up 13.84% gross of fees. The next question, so what is causing this downturn? Well, the recent market environment has been unprecedented. Through January, the S&P 500 Total Return Index was up 15 months in a row and 22 out of 23 months, something that's never happened before. In our opinion, the market has been overbought for some time and was due for a correction. However, as the financial media noted yesterday, this sell-off was precipitated by no significant headlines. The global economy is still booming, and any changes in market conditions were largely expected, making the severity of a correction a shock. For example, the correction appears to be triggered by the rapid change in the 10-year note after it broke through last year's high of 2.63% and spiked to 2.86%. It's not the level that has traders spooked, it's the velocity of the rise. Another catalyst for the sell-off could be the 2.9% hourly wage increase, the highest since 2009. This could be a sign that the long-awaited increase in inflation is around the corner. But again, neither of these factors should come as a surprise. Now, a few days ago, on January 19th, in an email Potomac advisors sent to me, they said, quote, "Since mid-December, we have seen an upward trend in the volatility measure called VIX, and most markedly in the last 5 days, even with the market spiking up. This is unusual and a far cry from last year when the VIX was at the lowest levels in history, despite day after day of incremental market advances. In spite of the sharp 2.5% rally in the Dow Jones Industrial Average in those 5 days, the advanced decline line has barely budged, up only 300 points. The sharp intraday 386-point downside reversal on Tuesday may be a sign of a short-term blow-off top. For now, Evo has us moving to the sidelines after capturing a 1.4% increase on Wednesday. With a strong prospected government shutdown tomorrow, it may prove to be a market-moving event, on top of the 10-year Treasury nearing the 2.63% level, a level market maven Jeffrey Gundlach says a penetration of which to the upside would lead to an acceleration of the rise of interest rates, taking down the stock market with it. Something to think about, however. We do best following our quantitative models and will continue to do so." End quote. We continue to believe the major reasons for the sell-off are due to an over-exuberant market that no one thought could go down, profit-taking, and a snowball effect precipitated by algorithmic trading where computers make the decision. Unfortunately, this time Evo was on the wrong side of the Bitcoin. Good luck to everybody, and remember that past performance is no guarantee of future results. You should always consult a qualified and licensed advisor before making investment, tax, or related decisions. Andersen Wealth Management is a registered investment advisor, and we receive Evo signals through our partnership with Potomac Advisors, also a registered investment advisor.